Hey everyone, welcome back to Corporate Decoder. Today we're diving into Boxlight Corporation's latest annual report, and trust me, it's a bit of a roller coaster. Think of it as that school project you barely finished, hoping you'll pass, but deep down knowing there might be some serious issues. Let's see if Boxlight made the grade. We're looking at Boxlight's annual report, a Form 10-K for the year ending December 31, 2024. In it, Boxlight gives investors a deep dive into its business performance and financial health. They're a tech company focused on interactive learning solutions, mainly in education, but also trying to get into the corporate and government sectors. They sell interactive displays, software, and even STEM kits. But before we get too excited, there's a whole section dedicated to risk factors. This is where they lay out everything that could go wrong, and let me tell you, it's a long list. It's like the company itself is not sure if it can stay afloat, or as the report mentions, if they will be able to continue as a going concern. One of the biggest red flags is that they admit they haven't been following all the rules in their credit agreement. That's a loan deal they made, and it has some rules they have to comply with. They couldn't keep up with certain financial targets, and this is a big deal because it can trigger the lender to demand all the money back immediately. So it is not in compliance with what it calls their senior leverage ratio. The report continues, these conditions raise substantial doubt about our ability to continue as a going concern. That is the company basically saying that it is not sure if it can continue operating, and there's substantial debt. They also have preferred stock, which is a type of stock that has special rights. The people who own this stock might want their money back soon, and Boxlight may not be able to pay it. All this means Boxlight might have trouble raising more money and even continuing as a business. That is bad. Then, of course, there are external risks that are not controlled by the company, like global economic or political conditions, including the ongoing conflicts between Russia and Ukraine and Israel and Hamas. And if anything interrupts the global supply chain, they might have trouble getting products. The pandemic also made their business take a hit because if there are no physical classes, the company won't be selling anything. Let's get to some numbers. Total revenue was about $1995.49 million in 2024, which sounds like a lot, but is actually down 23.1% from the previous year. Basically, they lost almost a quarter of their sales due to reduced demand. Their cost of revenue was also down, which is good, but gross profit. The money they make after subtracting the cost of goods was $46.9 million compared to $63.3 million the year before. This means they are making less money on each sale. Their general and administrative expenses, which are the costs of running a company, increased. This is because there was an accelerated amortization expense, meaning they had to write off some assets. However, they have less employee and marketing expenses and less travel expenses, which help the bottom line a bit. They have been increasing their spending in research, meaning they are investing more money into figuring out new technologies. Now, for the really bad news, their net loss was about $29.6 million, even though that's technically better than the $40.44 from making any profit. To help explain how they are doing, Boxlight uses some non-standard metrics, EBITDA and adjusted EBITDA. Basically, they are ways of measuring profit that takes out some of the expenses and accounting tricks. The report mentions they use EBITDA and adjusted EBITDA as financial measures to evaluate the profitability and efficiency of our business model. So what's Boxlight doing to try and turn things around? They are streamlining business operations and trying to offer what they think are more attractive and easier to integrate technologies and products into schools. As part of this strategy, they are unifying all their display products under the Clever Touch by Boxlight brand. They signed a 15-year lease for a new headquarters in the UK. They are streamlining how their different subsidiaries operate together and hoping to make quicker decisions as a result of this streamlining. They also have a good range of suppliers in the USA, Taiwan, China, Germany, and Turkey, which they hope will allow Boxlight to manage the logistical challenges with the global economy and shipping prices. Of course, having operations in lots of different countries brings its own set of problems like dealing with different laws, taxes, and currencies. They also must comply with things like the Foreign Corrupt Practices Act, which is designed to prevent bribery. And one very important risk that the company recognizes is that they may not be able to keep their stock listed on the Nasdaq, stay listed. They had to do something called a reverse stock split, which is when they take a bunch of shares and turn them into fewer shares to increase the stock price. It's kind of like rearranging the same amount of pizza slices to make it seem like you have more fall of, while they have managed to regain compliance with the Nasdaq's listing requirements. Boxlight acknowledges there can be no assurance that the company will maintain compliance with the bid price rule, which basically means that the price may sink and they might get delisted again. Finally, a few more things that could make investors hesitate. The company has some warrants, which are essentially options to buy stock that have some weird terms. These terms could make it harder for another company to buy Boxlight, even if it would be a good deal for shareholders. Now let's zoom out and think about all this. Boxlight is trying to adapt to a changing market by streamlining operations and focusing on integration and new products. But they're facing major headwinds, like a lot of debt, global uncertainty, and the constant need to innovate to keep up with competitors. It looks like Boxlight needs to show it can manage its debt and generate sustainable profits to maintain the company's going concern, as the report mentions. However, it also has some opportunities given current industry growth. Overall, Boxlight is in a tough spot. It's a company trying to navigate a lot of challenges, and whether it can pull it off is still an open question. You should closely monitor its future financial data to see if it gets back on track. Thanks for watching. If you found this helpful, give us a like and subscribe. Let us know your thoughts in the comments below. Until next time, stay informed.